We've managed to get Meredith Whitney to come talk to us this morning. Meredith Whitney Advisory Group, of course, noted bank analyst. And we're going to talk about the Fed and what it means for banks. But first, boy, this Nasdaq debacle just speaks to the fact that there are still significant risks in the system. It's shaky, and there's a continued need for new regulation.
Yeah, ironically, right, it's not human error, it's technological error. And you think with all the advancements that are made and all the companies that the Nasdaq represents, how could this happen? I mean, it was shocking. I saw the Bloomberg headline, and it gave me significant pause. Yet again, almost a year later, yet again.
And what I find interesting is that it's not really being talked about here. I mean, there are bigger, broader issues.
We talked about it a bunch last
night. Did you?
Okay.
Yeah.
Everyone was shocked again.
What is the consensus?
Well, the consensus is you can't believe it would happen, right? So there's an argument, and I'm not trying to go back to 20 years ago, but there's an argument that the system wouldn't break down for as long if there was more of a human component. But the fact that and we're not even clear what really caused it. So it was it's just sort of it's surprising.
It's
for
a
sure.
Risk, yeah. I want to also ask you about another story that's in the news. Alex and Tom were going over this idea that Moody's may downgrade their outlook, their credit rating for some of the biggest banks, the Goldman Sachs, the JP Morgans, on this idea that the government might not be there with taxpayer money to bail them out again as the government rethinks the policy. Do they deserve a downgrade on that notion?
It's unclear what moves the rating agencies to do one thing or not. It's clear that the banks have a lot more capital, but it's also clear that their revenue model is, in my opinion, unsustainable because they've been so over-dependent over the last few years on quantitative easing and the Fed purchase program. So they're so dependent upon cheap money. I think that's a larger issue than whether the government bails them out again. I don't know that there's political will not to bail these guys out, to see another institution suffer, but again, I think it's the fragility of the revenue model for these guys that's a bigger concern.
So let's get straight to the Fed policy and the impact on bank revenues. The yield curve is steepening. Theoretically, that should be good for the banks.
Theoretically, that should be good for the banks, but the banks have suffered from a very low loan-to-deposit ratio, right? So it would be good if they were making great loans and they would benefit from the yield curve steepening. What has happened, though, is because loan demand across America has been so weak, they've made more money from their securities books, and so they have the impact of the rates going higher, the value of their securities going lower, and taking a real hit to book value. On top of that, you have higher rates really impacting the mortgage market. So two things that have carried the banks thus far has been QE, propping the values of their assets higher, and mortgage, which has given them some type of relief in terms of refi fee income. And both seem to be part of the past. So I think the second quarter is going to be surprisingly weak for a lot of investors that are still propping these banks up at these current valuations.
And look at the impact. Wells Fargo already announcing just this week more than 2,000 layoffs when it comes to mortgages on this idea that refinancing has peaked out.
Yep.
And we're going to see more of that?
I think you're going to see more of it but also a lot of what Wells Fargo did has to do with credit too. So the banks, which were understaffed from mortgage collectors and whatnot because credit had been so benign for so long, just hired so many people in the back office to chase down loans, right? To chase down as collectors. And it wasn't so much necessarily the underwriting, it was the servicing of it. So what you're seeing is JP Morgan has announced that they're reducing a similar amount of mortgage servicers. Bank of America has been doing it. I think it's going to be prolific throughout Wall Street.
Legal costs are building as well. JP Morgan is in the headlines nearly every single day for an investigation or a charge, you name it. Is this going to have to be a factor that weighs against the banks as well in the next few quarters? It
has been a factor. So when there is no money, everyone looks to where there is money. The banks are now well capitalized, so now it's the Willie Sutton, why do you rob banks? Because that's where the money is. And I think it's only going to get worse. So if you think of all the areas that don't have money, the states that don't have money are going after the banks. Any organization that is looking for a big payday will go after the banks. It'll only get worse. I think that's probably the very weak revenue model and the legal risk are probably the biggest risk for the banks at this point.
Is JP Morgan being targeted specifically singled out fairly or unfairly?
I don't know. You wonder whether it's just J.P. Morgan's time, right, in the rotation, because Bank of America had a hideous 2010, 2011, part of 2012, and J.P. Morgan was flying high during that time. I don't really know. I wouldn't want to be J.P. Morgan at this point, because every morning there's something new. But you've seen so many banks in a similar position. Goldman Sachs clearly was in that position.
But should Jamie Dimon be afraid? Should he be scared of this?
Well, he just got approval to be, to maintain king status.
But do you get the sense that they're going after him specifically?
They always make it personal when they go after a bank. So because he is his face is so heavily linked with J.P. Morgan, of course they're going to go after him. Whether it's entirely, he's not doing every trade at the bank, but if he's going to get the glory, he's going to get the grief. And he's certainly getting a lot of grief right now.
You guys were at a dinner last night with a number of Fed presidents and economists. What is the vibe right now when it comes to this uncertain outlook on Fed policy? I
think the big vibe is, of course, who's going to be the next chairman, because that will set the tone for for policy going forward, and nobody knows, right? So you have these candidates that seem impossible to confirm, and then the safe candidates also that you want seem impossible. I think Don Cohn, I'm a big Don Cohn fan. I was a huge Tom Honig fan, but as a Fed governor, I think Don Cohn is right there, and he's such a servant of the country. And I think the other choices are very difficult leaders, right? So what you want is, the best type of harmony you can get within a Fed, and what's on the table now is not suggestive of bringing that type of camaraderie together.
Don Cohn, who is not political, safe choice, former #2 at the Federal Reserve. Is anyone talking about him as a serious candidate?
Obama mentioned it, but most people think it's a sort of a throwaway line. Part of the problem is this is going to be a political pick. There hasn't been a Democratic chairman of the Federal Reserve since 1988, and the Democrats feel it's their turn, they're in charge, and they should get one. So there's going to be much more of an emphasis on the politics of the person who is chosen, which is why Larry Summers and Janet Yellen are both leading candidates, because they're both identified with the party.
But
the interesting thing
is why this group finds it so difficult to grasp that, because this is such a largely apolitical group that just wants the best policies.
The most brilliant economist. What happened to that?
The taper question is interesting, because one of the things that's being discussed around here, and I had a conversation with several Fed officials last night, is do you want to bind the future Fed chairman by adopting a policy that would continue after Ben Bernanke is gone? And not only after Ben Bernanke is gone, but after a number of the governors have left, because several of them have their term expiring. And so you could have an almost all-new Fed, and of course several of the Fed bank presidents are retiring next year. So you could have a whole new Fed that is going to have to carry out a policy that they didn't vote for. And that's a serious question.
Talk about uncertainty.
Yeah, particularly given the fact that the consensus is that Bernanke stays through the January meeting, through the first initial tapering, and then passes the baton with the policy already intact.
Well, given the political landscape here, what does a Larry Summers-led Fed mean for the big banks?
It's unclear, because he has written some great papers in his past, but then he's gone against the very policies he's written about in the papers. So I think he is he's someone that no one really knows where he's going to stand on a given issue. He's pro-markets. He was pro-QE, and now he's against QE. I think that's probably the biggest wild card. You don't know what you're going to get with that appointment, and I don't think anyone would accuse him of being a great kumbaya leader, developing great harmony with anyone. He's he's a guy who's very confident in his own abilities and does not rely on anybody else to form his decisions. So I think that there are a couple of issues here. Nobody knows how he would be, because he's incredibly independent. He's a one-star animal, if you will. And then what happens to the regulatory policies? He was very pro dismantling Glass-Steagall. What happens going forward? Tarullo has been incredibly aggressive, being a tight regulator to the financial services companies. So that is, I think that Wall Street should be. You would imagine Wall Street would be more promotive of Yellen than Summers. It seems the Obama administration is the most promotive of Summers.
All right. Well, it's a great discussion. Just kicking off the debate here from Jackson Hole. Thank you, Meredith Whitney, Meredith Whitney Advisory Group.